Okay, I think I missed it. Okay, so in previous class we have done our net profit, operating profit, and operating ratio. Okay, now there is only one ratio left, but two different ratio are not included in your syllabus, but I will teach you so that it will be helpful for you to understand the other ratios, okay, or financial statement. So the first ratio is the return on capital employed. Okay. So return on capital employed. Do you know what is capital employed?
Yes, sir.
Okay. What is it?
So it is the investment made in the business.
It is investment made in the business. Okay. So what are the items of financial statement we include in capital employed? What are the items name that is to be included in capital employed? If you will be given a question, then what will be added in capital employed?
So the shareholders fund,
Shareholder fund, okay.
long-term debt.
Long-term debt or long-term borrowing, you could say. Yes.
Yes, sir.
Yes. So these two are our capital employed. These capital are employed in business for long term. That's why it is called capital employed. The current assets, current liabilities are short term in nature. That's why we don't include those items in capital employed. Okay.
Yes, sir.
Okay. So what it tell us? Return on capital employed. So the understanding of this ratio is when we do a business, we need to know the profit. Okay. We need to know the profit in amount form and also in percentage form, that how much money we have invested in our business and how much we are getting in return. Okay. So it is like if we have invested 1 lakh rupees in business, then we are getting 20,000 or 30,000 different amount form. But we need to know that how much percentage we are getting in return. So it is 20%, 30%. Okay. So it is a ratio which tell us that our profit is sufficient or not in comparison to our capital employed. Okay.
Yes, sir.
Okay. So I told you in one of the previous class that let's say we have invested in business 1 lakh rupees and we are earning 1,000 rupees. So it is very low profit we have. It is insufficient profit. Or we have invested in business 20 lakh rupees, let's say 20 lakh rupees, and we are earning 1 lakh rupees. So by seeing this 1 lakh rupees in comparison to 20 lakh, it is 5%. But if we talk about only amount, then 1 lakh is a good profit. Yes. So by seeing the amount, you can say that it is sufficient. But when we compare it with our capital employed, then it looks like that it is insufficient. Okay. So that's why we need to know the percentage form of return. Is that clear?
Yes, sir.
Okay. So you can see it assesses the overall performance of the enterprise. It measures how efficiently the resource of the business are used. Okay. Now you can see the formula. Return on investment equals to net profit before interest and tax into 100 divided by capital. Now, in one of the ratio, we have studied this net profit before interest and tax. Yes.
Yes, sir.
Okay. Now, can you tell me when net profit after tax is given in the question? Net profit after tax. Then how will you calculate net profit before tax?
So we have to add tax and interest to it.
We will add tax first,
Yes, sir.
then we will add interest on long-term borrowing. Okay. So this is our profit before interest and tax. Okay. Uh, Now, if tax rate is, let's say, 20%, how much our profit before tax will be? If tax rate is 20%, net profit after tax is 1 lakh, then how much profit before tax we have?
So I'm calculating one minute. So 25,000.
25,000.
Yes, sir.
This is tax amount.
Yes, sir.
Okay. So our profit before tax will be 125,000.
Yes, sir.
Yes. Good. It is correct. Actually, we have to calculate like this. Sorry, 80. Yes.
Yes, sir.
Done this? Okay, fine. Then you understand, you remember the concept of net profit before interest and tax. Okay. So this is how we calculate our net profit before interest and tax. It is actually already written by you, so I don't think it is necessary to copy this. Okay.
Yes, sir.
Now, capital employed. How we will calculate our capital employed? Actually, capital employed is written here. You can see capital employed. There is two approach to calculate capital employed. The first one is liability side approach, and the second is asset side. So in liability side approach, the share capital, long-term liabilities, these are given. So we will add these items and we will deduct fictitious assets, accumulated loss, or any non-trade asset. Okay.
Yes, sir.
Okay. Do you know if question tell you about long-term investment. So long-term assets will be classified as trade investment or non-trade.
Can you repeat?
If in the question there is a long-term investment given, then it will be classified as trade investment or non-trade investment.
So trade investment.
Trade investment. Yes, any investment given in the question, okay, it will be treated as trade investment until it is specifically said that it is non-trade.
Okay, sir.
Okay, so you can add it in note. Actually, you can see here, non-trade investment is excluded while determining capital employed. Therefore, income from non-trade investment are also excluded from profit. So if there is a non-trade investment, let's say 1 lakh rupees and 10% interest on it. So we will deduct 1 lakh from total assets and we will remove that 10,000 from net profit before interest and tax out. Okay.
Yes, sir.
Because we don't take non-trade investment and income on those non-trade investments. Okay, that's why we have to exclude, we have to remove these items from our calculation. And if there is no information about information that is it is trade or non-trade, then we will always assume that investment are trade. So this is your return on capital employed. Okay. Now we take a question for this. Non-trade. Okay, 1 minute. Okay. So can you see the question?
Yes, sir.
Please read question number one 140. Calculate return on investment from the following details. Net profit after tax 6,50,000. Rate of income taxes 50%. 10% debenture of 100 each is 10 lakh. Fixed assets at cost 22 lakh 50,000. Accumulated depreciation on fixed assets up to date 2 lakh 50,000. Current assets rupees 12 lakh and current liabilities 4 lakh. Okay.
Okay, sir.
Okay. So first of all, we have information about net profit after tax. What will we do here? Okay. So net profit after tax. ₹6,50,000 and plus tax at the rate 50%. So it also 6,50,000. So the total profit will be 13 lakh. Okay.
Yes, sir.
How we got tax of rupees 6,50,000?
Yes, sir. Because 50-50 will cancel out each other, so it will remain.
Yes. Very good. So now, for interest, what will be added? 10 lakh of 10%. It is debenture. Okay. So our total interest will be 1 lakh. Profit before taxes calculated here. Profit before interest and tax. Okay. Now, the rate is given, fixed assets is given, accumulated depreciation is given, current assets and current liability. Now, capital employed. So for capital employed calculation, we need fixed assets at net cost, not on only cost. We need net value of fixed assets. That is 22,50,000 minus 2,50,000. So fixed assets plus current assets minus current liability. Fixed assets will be 20 lakh. Actually, full amount I'm writing 22,50,000 minus 2,50,000. Current assets value is 12 lakh and current liability is 4 lakh. This is our 20 lakh. Uh, 20 lakh, well, 32 minus 4, it is 28 lakh. Now, return on capital employed.
So could you explain again what we did with the fixed assets plus current assets?
Okay. Actually, the fixed assets you can see here 22,50,000.
Yes, sir.
Okay. And accumulated depreciation on fixed assets up to date is 2,50,000. Okay. So depreciation is deducted from assets. But there is the two concept of depreciation. One, when the depreciation is directly deducted from the fixed asset. The second is when our depreciation is accumulated in a separate account and these two accounts are shown in balance sheet. Okay. So fixed assets at cost 22,50,000 minus accumulated depreciation 2,50,000. This is the net value of asset. Okay.
Okay, sir.
So it is like when we purchased our fixed asset, the cost is 22,50,000. Okay. And after charging depreciation for 3 years, uh, we get total depreciation of 2,50,000. Okay. So our accumulated depreciation is shown in different accounts and our fixed asset value is shown in different accounts. So it is not already deducted from fixed asset. So that's why I am deducting it from here. So 22,50,000 minus 2,50,000. This is our net fixed asset.
Okay, sir.
Okay. Now, so This is our 28 lakh, and return on capital employed equals to net profit before interest and tax. Divided by capital employed. So 14 lakh divided by 28 lakh into 100. So you will get 50%. Okay.
Yes, sir.
So this is our return on capital. There is a question related to balance sheet also given. Actually, there is some of the information like non-current investment, 10% investment, 10% non-current investment. Both are given.
So you're stuck.
Okay. So now there is a question related with balance sheet. Where non-current assets is given, and in non-current assets, fixed assets, non-current investment, and in non-current investment there is two classifications: trade and non-trade. So 10 trade 10%, non-trade is also 10%. It is 2 lakh and 1 lakh 20,000. Okay, if I ask you what is non-trade investment actually, can you tell me? Ritika,
Yes, sir.
what is non-trade investment?
Sir, is it investment related to um, sir, I'm not
Yes.
sure.
Okay, it is investment which is that not directly related with our business. Okay, we have invested, which is a different type of investment, which is not related, uh, not anyhow related with our business.
Yes, sir.
Okay, so like when we purchase, let's say when we purchase a building, okay, for our business purpose, then it is categorized as building, not as investment. Okay, and when let's say I'm doing a business of something and I have deposited some money into bank, okay, to grow, okay, or we have invested money in mutual funds, share market, so these are non-current investments. These are not related with our business. Okay,
Yes, sir.
so these are the information apart from this. uh yes, this one, this is the half part of balance sheet, and there is one more information which is net profit before tax. Net profit before taxes. Now, this is actually in balance sheet form. So sometimes students get confused about this. Net profit before tax is 9,72,000. Now, in this question, fixed assets is given. Our trade investment will be taken, and current assets will be taken. Yes.
Yes, sir.
And we will not take this 1,20,000. Is there anything else we have to do with this non-trade investment?
So should we deduct it?
No. Actually, if we are not taking the amount in calculation, then why we will deduct? If we were taking the total of balance sheet, then we need to deduct this one. The total of balance sheet is 33,20,000. So if we have taken this amount, then we need to remove non-trade. But we are only adding these three amounts: 16 lakh, 2 lakh, and 14 lakh. So it is 32 lakh. Okay.
Yes, sir.
Anything else? Is there anything else we have to do with this non-current investment?
No, sir.
Okay. Actually, the one more thing we have to do, that we have to remove the non-trade investment income. Income means if we have invested this 1,20,000 in the market, then we will get this 10% from that investment. That is our not our business income. So we have to exclude that amount from our profit.
Yes, sir.
Okay. So we will add here the solution part is our net profit before tax is 9,72,000. Okay, tax is already added. Yes or no?
Yes, sir.
Because we didn't deducted tax here, so we don't have to add tax here. It is included in this. So 9,72,000. What will be added here first?
So
Added or
interest.
deducted?
Sorry, sir. What?
Added or deducted, whatever. What we have to do here first?
So we'll have to add interest.
Interest. The interest on non-trade investment.
No, sir.
Okay, then
So interest on
this
long-term.
borrowing, this 16 lakh into 15%. This is our long-term borrowing.
So you're not presenting the question.
I'm not visible.
You're not presenting the question.
Okay, you are not in the question. Okay. You're seeing it now?
Yes, sir.
Okay. So this amount.
Yes, sir.
Okay. So we will add it first. Yes, we need to calculate profit before interest and tax, but profit before tax is given. So we will add interest. 15%. It will be 2,40,000. So the total will be 12,12,000. Now we will add minus no income on non-trade investment. 12,000. 1,20,000 into this is your 16 lakh into 15%. Now 1,20,000 into 10%. So 12. After this, our capital employed will be, we can use any approach in this calculation. Either we can take shareholders fund and then add long-term borrowing, yes, or there is asset side approach. We can add our non-current assets, trade investment, and current assets, then deduct current liability from this. Current liability is 8 lakh. Okay.
Yes, sir.
So any of these two methods we can use. First of all, we will take liability side approach. So our shareholder fund is 5 lakh. Reserve and surplus is 4,20,000, and long-term borrowing is 16 lakh. Now we will deduct any fictitious assets or non-trade investment from this fund. So 1,20,000 is our non-trade investment. The total 25,20,000 minus 1,20,000. This is 24 lakh. Our return on capital employed will be return on capital employed will be 12 lakh. That is our net profit before interest and tax, divided by 24 lakh. That is our capital employed. So total is 54. Is this clear?
Yes, sir.
Okay. Now, actually, all the ratio that is important for examination is already covered. All the ratio of your syllabus. Now there is two more ratio which is important to understand the financial statement. The one is earning per share, and the second one is price earning ratio. Okay, so earning per share means how much a company is earning for its shares. Okay, earning per share means the speed of earning for a company, by a company for its shareholders. So we don't keep in mind here the share price. We just calculate the earning per share. Either it is per share we are earning 1 rupees, 2 rupees, 5 rupees, 10 rupees, whatever. But we don't consider the price of that share. Okay. Earning per share formula we use is earning available for equity shareholder. Available for equity shareholder divided by number of equity. It is like uh, in a family, let's say, father is giving 50 rupees to five children. Okay, so they will distribute it 10 rupees each. 50 rupees divided by 5, 10 rupees each. The same concept goes here, that how much earning is available for equity shareholders. We take only earning which is available for equity shareholders, not anything else. Okay. So in previous formula, we have used net profit before interest and tax. Okay. Before interest and tax means that earning is for long term capital employed, you can say. It is also for long-term borrowing. It is also for preference shareholder. It is also for equity shareholders. So all the income is included in profit before interest and tax. Is that clear?
Yes, sir.
So in return on capital employed, we take the profit of all these three: preference shareholder, equity shareholder, long-term borrowing, and also the government, because we also included the tax in uh, net profit before interest. So these four you can. But in this case, in this calculation, we are taking earning for equity shareholders only. That's why we are dividing it by number of equity shares. Earning available for equity shareholders divided by number. Now, if in this portion, profit before interest and tax is given, profit before interest and tax is given, so we will deduct our debt, interest on debt first, and then we will deduct tax from here. After that, we will deduct preference dividend. You know what is preference share? Actually, preference shares are shares which have preferential rights to receive dividend first, and at the time of liquidation, means closing of business, at the time of liquidation, they will get their capital first also. Okay, so they have two preferential rights. First, right to receive dividend first. So that's why preference dividend will be deducted first. After that, this amount is earning available for equity share. Is this clear to you?
Yes, sir.
So we calculate earning available for equity shareholders, and number of equity shares is generally given in the quotient. You can see this quotient also. 5 lakh rupees is total amount of equity share, and the price of one share is 10 each. Okay. So total number of equity shareholders will be 50,000. Okay.
So your voice was lagging. Could you repeat again?
Okay. Uh, this total amount of equity share is 5 lakh. So value of equity shareholders is 5 lakh, and the price is 10 each. So divided by 10. Number of equity shares will be 50,000. Okay.
Yes, sir.
Okay. So this is how we calculate number of equity shares. Now, if we know the number of equity shares, we can easily calculate. Yes. So this amount will be taken here, here, and then you will divide it with number of equity shares. So you will get EPS, earning per share. Is this clear?
Yes, sir.
Okay. Now, after earning per share, there is a concept of price earning ratio. Okay. So I told you that in earning per share, we don't consider the price in calculation. Okay. So that deficiency is fulfilled by this second ratio, price earning ratio. Because every time we calculate profitability of anything, of any business, of any share, then we need to compare it with the price. Okay. But in earning per share, we are not considering the price of share. We are only calculating number of share. Okay. And then we divide the earning with that number of share. So we get earning per share. Now, uh, price earning ratio. So the formula of price earning ratio is market price of one share divided by earning per share. So it also results in the percentage, you can say, like we have calculated return on capital employed, we have calculated in percentage, but it will be in number form, only number form. Let's say our earning per share is 20 rupees. This is our EPS, and market price share is 200. Okay, so it is 200 divided by 20. Now it is 10 rupees. This is your uh, PE ratio, price earning ratio. Now, what does it mean by 10 rupees? It means we are earning 10%. If it is 20%, 20, then it means we are earning 5% in comparison to our share price. We are earning only 5%.
Okay, sir.
You understand how?
So the can you explain the 20%?
What?
So can you explain the how did we get the 5%?
Yes. Actually, the total income is 100%. Okay. Total income is, let's say, assume we always believe 100%. So whatever the number is, we divide this percentage by that number. So we will get 10. If we will divide it by 20, then we will get 5. So whatever the price earning ratio, it means we are earning this much profit, 5%, 10%. But we don't calculate it in percentage form. You need to know only how to calculate price earning ratio. So the formula is market price per share divided by earning per share. So this is our price earning. Okay.
Okay, sir. Yes, sir.
The thing is why we need to calculate earning per share, why we need to calculate price earning ratio. Yes.
Sir, I don't
Okay. Actually, the earning per share, whenever we want to invest, because in public company, the public is investing money. Okay, they purchase shares on the basis of past performance. So, what a shareholder see in a share before purchasing a share, okay, so he will see that how much company is earning for its share, okay, per share, and how much stability it has. Okay, so means the book value per share. You can say that its total asset is 20 lakh rupees. Okay, and after deducting all the liabilities and preference shareholders, we will divide it by number of shares. We will get the book value per share. Book value per share means how much a share is actually worth in books. So it is two things we see in a before purchasing a share. Total asset is, let's say, 5 lakh, and liabilities plus preference shareholders is 3 lakh. So the balance amount is 2 lakh here, and this amount is after deducting all the liabilities and preference shareholders. So we will divide it in equity shares. Let's say the number of equity shares is 10,000. Number of equity shares is 10,000. So if we divide it by 10,000, we will get 20 rupees per share. Yes?
Yes, sir.
2 lakh divided by 10,000, we will get 20 per share. Now this 20 per share is our book value, but the share generally not traded at their book value. Okay, it is traded at market value. So the book value is different price and the market value is different. Okay, like
Yes, sir.
right now, if you will see the value of one share of a Tata Power company is rupees 1, but it is traded at 230 rupees. So the book value, not book value. Face value is 1. Book value is different. It is like you can see book value is around. Let me check one. You can see it also on net. Book value per share of this taking time. Okay. So yes, this is it. Yes. Tata Motor actually. You know the company Tata Motor?
Yes, sir.
Okay. The book value per share of Tata Motor is it is total around 150, 5 or 10 rupees up or low. So, but the actual market price, this is book value. The market price is 618. This is market price. So you can see the book value is different, the market price is different, and the face value is different. Face value may be 2 rupees, 5 rupees, or 10 rupees. Okay. So this is how the company shares traded in the market. Okay. So this ratio information is to know the position of the company. That's why I have given you a like example of Tata Motor, because you will understand it if you see on the net. Okay. So you can search any company. You can see their book value and market value. So this is how we calculate. So book value per share I calculated here is 10 rupees, 20 rupees per share. The book value is 20 per share here, and the actual market prices, let's say I have taken the example, yes, this is the actual market price is 200. So it means they are traded at 10 times higher. Yes or no?
Yes, sir.
Okay. So the actual book value is 20, but they are traded at 200 minutes. It means they are traded at 10 times higher. Now, if we compare our this 200 with the earning that is 20, it is 10. It means the company is earning 10%. Okay. I told you how to calculate this percent. So company is earning 10%. So this is what we see in a company, that a company is uh, getting profit for its shareholder, or it has sufficient asset to cover the value of asset. Okay, these two things we need to consider for calculation of uh, for knowing the financial position of the company. So that's why all the ratio is used to understand the financial viability or feasibility of a company. Okay, is that clear?
Yes, sir.
Now, there is one more concept related with this chapter, that is dividend. Can you tell me what is dividend? Dividend,
So it's the profit or share which goes to the shareholders.
yes. So dividend means share in profit of a company. It is given to shareholders. Now, I told you that here is earning per share concept, EPS. So a company is earning 20 rupees for its share, 20 per share. Okay, but it gives only, let's say, 12 rupees per share as dividend. So it will be called dividend per share, DPS. Okay.
So could you repeat once more?
The company is earning 20 per share. It is EPS of the company, but company is distributing only 12 rupees per share. Okay. It is called DPS, dividend per share. Is that clear?
Yes, sir.
Actually, my voice is still lagging.
Yes, sir.
Okay. DPS actually it means dividend per share. And the 8 rupees remaining is called retained earning. Retained earning. It is transferred to general reserve. General reserve or profit and loss. Is it clear?
Yes, sir.
Okay. So this is our full ratio chapter. Do you have any doubt in any of the concepts?
No, sir.
Okay. So actually, in any case, if I forget to send you the homework, then you can try the question from your book. Okay.
Okay, sir.
Okay. So have you tried any question from your book, or you just leave it?
No, sir, I've done.
You have done some question.
Yes, sir.
Okay. So is there any doubt in net profit, operating ratio, and operating profit ratio?
No, sir.
Okay, then that's all for today. You will receive this homework, and we'll discuss the next chapter. Okay, can you tell me which chapter uh, after ratio you want to study? Actually, the
So,
continuation. Yes.
so can you say it again? start comparative and common size statement chapter.
Okay. Okay. We can do it. Okay. Okay, fine.